stealing our jobs, and that's what's going to happen. Otherwise, we don't have to do business with them. We don't have to do business. We can make the product right here if we have to, like we used to. Remember, like we used to.
And joining me right now is the former Office of the Management and Budget Chief Economist and the Committee for Economic Development Chief Economist, Joseph Minarik. Great to see you, Joseph. Thanks very much for joining us this morning. Your reaction to all that's taking place, this is the 11th round that these two go in. Do you think that there's going to be wiggle room here for a deal between the two countries, which have completely different approaches to their economies?
Well, nobody wants this deal to fail. There is space for concession. It's getting to be very hard. It's one-on-one. As you noted, Maria, and I think it's the key point, these are very different modes of economic management. A lot of what China does is not very transparent. It's very hard to write rules, and it's very hard to enforce them. And that's part of what's making this so difficult.
Which is why that article from Reuters yesterday really was so stunning, but also very much apropos, saying that China backtracked on virtually every point on this deal, most notably the forced transfer of technology that the U.S. is telling China that you can't keep forcing companies to transfer all their technology over to a Chinese company when that company does business in China, and the IP theft. These are things that, I don't know, in my view, are cultural. So can you move the needle on that?
We have to hope that our negotiators can do that. But again, how do you write the rules? How do you make sure that what are now ostensibly voluntary agreements with U.S. firms who want to get into the Chinese market and are willing to pay a price in intellectual property to do it, are not forced to do that. That is not the normal rule of commerce around the world, and we do have these differences with China. China does see its place in the world in a very expansive sense, and it's going to be difficult to make a change in that mentality.
So what are the downside risks of no deal?
Right now, the U.S. economy is suffering. We do have for example, in some of those tariffed goods, you have increases in prices for U.S. consumers, washing machines, a lot of imports, roughly half of imports worldwide. China may be a little bit different, but roughly half of imports worldwide are materials or components that go into products that we then sell and possibly even on export. So the U.S. becomes less competitive. Costs become higher for U.S. manufacturers, which means that third parties importing into the United States might become more competitive as an unintended consequence of all this. But it can be costly.
Yeah, we've been speaking with a number of businesses who say, yeah, it's likely in the cards if this continues that we will be raising prices. We had the head of Trek bicycle maker just the other day, who said, yeah, it is in the plans that we'll likely have to raise prices on bikes. So I guess if consumers are going to be faced with higher prices for all sorts of goods that they're buying, it's better to do it now while you're talking about 3.2% economic growth and a backdrop that is pretty strong in the U.S., right?
Well, inflation right now is very low, and we do have relatively robust economic growth. We could be, however, eroding our competitiveness over the long term. And in the long term, a settlement is, of course, much better than allowing this kind of a disagreement and higher tariffs on both sides to go on.
Yeah, this is a really good point. All right, we'll be watching this. Joseph, great to get your insights. Thanks so much.
Thanks for having me.
Joseph Minarik there joining us this morning. We want to turn to Uber's IPO, the big story of the week. The ride-sharing giant